Another thing that I wanted to ask you, in our group where we have the lecture, Vladislav wrote the questionnaire where we ask you to send your Gmail accounts. We will use them in order to organize the activities during the seminars. So please, provide information necessary. Otherwise, we will have troubles assessing your class participation, and then it might affect your final grade. So make sure you submit the information there. There is a link in the MS team. So this team where we work with you now. Now we are proceeding to today's topic. Today we start with the topic of the cash flows, net present value, and estimating the value of money over time. And we will dedicate 2 classes on it. Today we cover first part. Today we cover the very basic things regarding estimating the time value of the money over time, simple and compound interest rate, future values and the present value, and net present value, which is a related topic to the future value and present value, IRR. So NPV and IRR are the estimation of the project effectiveness. So there are criteria that we use in order to decide whether the project is worth implementing or not, and those 2 are based on NPV and internal rate of return. And another estimation, which is estimate another thing, but still quite useful and widely applied in all kinds of investment, it is payback period estimation. On the next class, we will go further and discuss particular types of cash flows, and so you will be well equipped for subsequent topics when we will discuss already special types of securities. So we start with a very basic idea, but out of this simple idea, we have several consequences. There are several conclusions that we made out of this, which are the crucial and foundational in corporate finance. This idea can be put in this form: ruble today is worth more than ruble tomorrow. If you have a choice of either receiving money now or receive them next year, if it is the same amount of money, there is no doubt that it's better to receive them now, and there are multiple reasons for it. Maybe, by the way, you can say why it's better to receive money now in the financial sense. There are some clues presented for you on the slide, but maybe you can explain a little bit yourself. Could some of you please either write or speak?
May I answer?
Yeah, would be great, please.
Well, the money can be, well, first one, opportunities. I'm assuming that what is meant here is to invest or use the money in a specific activity which can cause or result in more money. For example, putting the money in deposit in a bank or buying a bond can be an opportunity. Or, for example, the inflation over time, if the country's inflation is positive, then the worth of the money will decrease over time. So the money is, if you're receiving the money next year, it's not really worth anything that it used to be, unless the amount of money increases itself.
Yeah, it's a great, very accurate answer. That's like you use the same example I usually use regarding the opportunities and inflations, just to make sure that everyone understands it. why we say that money have different value over time? Because just taking money now, we can securely say that next year we can have more money out of this, because we just can put them at the deposit and have guaranteed some percent, like 5-6% guaranteed. So if you have an option to receive money now, having 100 rubles now equal to the opportunity of having at least 105 rubles next year, because otherwise you lose opportunity to make money more. Inflation is the same, it's related concept, because the interest rate on deposit is there mostly to compensate the potential inflation. So for example, like 8 years ago, we were able to purchase BMW 3 for, let's say, 1,500,000 rubles. These days, you will need at least 3 million rubles to purchase it. It means that the purchasing power of our currency reduced, and this process is called the inflation. That we need more money to purchase the same things over time, and this is also very relevant for the idea of the time value of the money, as if we compare money with the things we can buy on them, the purchasing power of money going down. That is why, again, money are not the same in price over time. And uncertainty, it is the most difficult to research the concept, and we will deal with uncertainty when we proceed to the topics of the risks. But on average, uncertainty means, in general, uncertainty means that more things can happen than will happen, and there are a lot of different things that might occur, and many of these events might affect the purchasing power of money, or we just can become unable to spend them, and so on. So we might not need this money later on, or won't be able to use them. And all those factors result in the issue that we need a tool to somehow compare the money in different time periods. Because then we consider some investment projects, we invest now, hoping to receive money later on as a profit. And we need to compare them. Just to use nominal values won't be correct due to the reasons we just discussed. And there is a special tools that we cover today in order to make this comparison better justified. To start with, we should maybe recall or learn. I'm not sure if you came across it. You might have heard of it even in school, but still, let's revise it. Then we talk about the future value of the money, let's say the deposit. We have two types of interest. There is a simple interest and compound interest. If we, going back to the example with the deposit, simple interest, then we talk about it. We assume that every time we receive the money, let's for the sake of simplicity, let's say we have 100 rubles invested, and every time we invested 100. Excuse me for the handwriting. 100 rubles at 5%. I'm not on my computer today, that's why handwriting is, but I hope it's still understandable. And what happens then we use simple interest? Every period we receive 5%. So by the end of the year one, we will have we multiply it on 1 plus 0.05, which is the same as 5%. And by the end of the year, we have 105. So this would be the same for both simple and compound interest. The difference starts at the beginning of the next year. If we talk about simple interest, then we take this 5. So this was period 1. And then at the period 2 here, we start again with 100. If we use some real-life example, it can be the deposit where all the interest you receive is allocated not on the same account, but on the separate account. So let's assume you want to live on the interest you receive from your deposit, and then you receive the money on the separate account, and every period you start your investment from the same amount, from 100. And then by the end of at the second period, again, you start from 100. And by the period 3, you go to 105 again. And this is repeated every period. Then again, we take this 5 rubles away and start from 100 again and again. And this is called simple interest. And the total amount of interest we make would be equal to the number of periods. This is T is the number of periods, and R is the interest rate. In this case, it was 5%. And in this case, in the case of compound interest, the difference would be starting from the period 2. Here we start from 105 at the second period. Multiplying again, here I forgot to put brackets. Here we multiply 1 plus 0.05 and proceed further. So, and this time we have more than 10. We would have 100. How much we would have? We would have 100. 110.25. And in the period 3, we start from this amount. And over time, so after the period 2, the difference would be, in this case, we have 10 rubles extra. In this case, we have 10.25 extra. And this is 0.25 is due to the compounding effect. And the longer we go, the stronger would be the effect of compounding. And by the way, this is very relevant for the personal finance. If you want to save money for retirement or some long-term purchases, it is important to start earlier, because over time, compounding will make a huge difference. Here is an example of the compound interest with 7% a year. This is how we calculate it over time using the formula presented above. If we would have simple interest, we would have just 14, but this is 0.49. It's due to the compounding effect, and I think further on I have more slides to illustrate it. And here again, some interactive activity for you regarding the investments. Let's discuss what investment options we have as a private investors. All of you have a right to open the brokerage account and invest your money in some securities, or you can just put money in some deposit. And let's assume, or maybe you really have some amount of money to invest, and let's consider what investment options we have. What do you think you should do if your investment target is 5 to 7% per year in Russian rubles? Where you think it's better to bring your money? What to do with them? What would you say?
May I ask something?
Yes, sure.
It's not a kind of question, but it's a kind of thing. It still depends on the fact that the investor is a risk taker or not. For example, if you're not a risk taker, you can invest in the gold market or.
No. It's not. It's risk taking is a relevant concept, but for every level of your risk appetite, there are optimal choice. Yes. So if you risk taker, you should aspire for the higher yielding projects. There is no sense to invest money in the risky project for 5% a year. It's just purely irrational. Your choice of investment is really affected by your risk preferences, but there are optimal investments for each level of your risk appetite. Do you see what I mean?
Yes, I see.
Yeah, so in that case, it is true that it is relevant, but no, for these questions, we have a rationale to judge. And we see that Philippe and Bogdan wrote in the chat that for the first level of interest, the optimal choice would be bank account. And I agree with you guys. So this is one of the safest investment, and this can be the optimal choice if you want to have safe return without the worrying. And by the way, if again going back to the personal finance, it is recommended. It is recommended to have some money in the most liquid form. Liquidity means that it is easily can be changed into the money without substantial loss. Because, for example, stocks, they are volatile over time, and it might be that if you urgently need your money back, you might lose the money because the stock market can be in a lower cycle and the current market price would be lower. But with the deposit, it is more secure. And what I wanted to say that in a personal finance perspective, you are recommended to have enough money. It is enough money as a safeguard for, let's say, your 2 or 3 monthly salary. And this fraction of your savings is recommended to keep in the deposit or some other liquid assets. Even if you have a high risk appetite, still it might be that you urgently need money, and in that case, it's good to have some fraction of your savings in the deposit, having securely having your income secured and making sure that you have enough money to purchase the food if, for example, you lose the job. What option you think we should choose when we talk about the 7 to 9% interest level? Huge, quite stable companies like Gazprom, real estate. Real estate is a good option. It is popular in Russia, and it's decent choice. But in our course, we will not focus on it. because we talk about the finance, and this real estate goes above the scope of our course. And the problem with real estate, again, this is liquidity problem, that it takes more time and you might lose money, then you need to sell it when you need your money back. But real estate is a reasonable option, and those people who invested in that several years ago, now the flats, for example, in St. Petersburg, they appreciated in price almost by 2 times in several years. But let's focus on financial options. Bonds and huge. So Polina wrote huge, quite stable companies like Gazprom or Sber. Polina, this is a good line of thoughts, but I'm not sure if you're familiar with it yet, because we will cover it in our subsequent classes. But anyway, I need to give some sneak peek here to discuss that we invest not just in the firm, but like these firms like Gazprom, Sberbank, they issue different types of securities. Some of those securities represent ownership right, like stocks. Other types of securities, like bonds, represent liabilities of the firm. And liabilities like bonds, what Philippe wrote bonds, and he is right here, bonds and bonds of the bigger firm like Polina mentioned, because the bonds of smaller firms, they might be still very risky because there is a substantial risk of default. This is 7 to 9%. What would be from 9 to 11?
And also the government bonds in 7 to 9%.
Yes, Vladislav. Yes, this is government bonds. They would also go in that segment. The yield difference between government bond and the bigger firm bonds might be not very big, but still again, we will discuss it later on, but there is so-called the risk-free rate, and risk-free rate is the rate of the national bonds, of the short-term national bonds. And this is considered the safest investment, but still it gives some yield for you. Securities of private companies up to 15% of income. Russian stocks. Yes, Russian stocks, and better stocks of bigger firms, securities of private companies. Arina, what do you mean by up to 15% of income? Do you mean it is investment strategy? So among your total investment value, you should invest 15% in this kind of securities?
I can't explain this in English, but I mean that you can buy securities of private companies, and доход будет до 15% в год.
Interest rate or interest yield up to 15%.
Yes.
I see. Yes, securities, they can be even higher, and securities is it is too broad for answering this question, because companies issue different types of securities, stocks, bonds. There are also derivatives, so papers, securities which present the right on another paper, like derivative on stocks, or there can be derivative on some oil or gold. And in that case, it's better to be more precise, because securities in this case is too broad. It's better to go with the terms like shares, bonds, and you are right that shares, they are supposed to provide higher return than the bonds. Here is a example. So Vladislav, thank you for that. Vladislav prepared this slide where he updated the information regarding the investment options available for us in Russian rubles. And yes, 7 to 9 is a sovereign bond. Sovereign bonds are the bonds issued by the state, and these days you can invest at around 8% in bonds which were issued by the Russian Federation. So countries, the whole countries also borrow money from people or from another countries, and in order to borrow money they issue the bonds, and when you purchase the bonds you borrow the money to the state. Also you can borrow money to the corporation, and the return there would be higher because the return of the interest rate on bonds of the firms should be higher than return on the bonds of the state. And that's because the company operates in the country and it has all the risks of the country plus some specific risks. And that is why the interest rate would be there, would be higher. And another option to invest if you want to have higher return would be, yes, Ivan, securities is a general term for for ценные бумаги, and it is broad term which we use for stocks, bonds, options, futures, and other derivatives. Please do not confuse them. These all no, except for the deposit. If it would be deposit certificate, it would be also securities. Deposit, because it's not the security itself, it is agreement between you and bank, but there is a there is a process, it's called securitization, when we transform some agreement into the security. And by the way, the securitization was one of the causes of the financial crisis. Then banks make special securities on their mortgages and sell those securities to other banks. So we can go from agreement to security, but in general, we use this term for the traditional types of securities like stocks, bonds. So here it is. The takeaway here is that we started from the premise that in order to compare money in time, we should use interest rate, and we should consider it. And now we see that there are different interest rates depending on your risk preferences. The interest rate that we will work with would be different. And now we move further to discuss how to work with it. This is the future value of the amount with the compounding. And if you invest 100 units of dollars or wherever at this interest rate per year, by the end of either 10 or 20 years, you will have this amount. If you receive at just 5% a year, in 10 years, you will have 63% extra. In 20 years, you will have even more. Yes, so this is the power, it's called the power of compounding. And you see that as the times goes by, the power of compounding increase, because as I explained in the beginning, each period we invest more and more and more money. And the longer the horizon, the better it is. That is why it's better to start saving money earlier, because you would have more due to the power of compounding. This is the similar thing presented in a graphical form. So future value of money that we invest for a certain period. Now let's discuss how we go back to this timeline. Before that, future value is how much money we would have if we invest some money, how much we would have at the next period. And we need to have the reverse calculations. If we have investment projects, and let's say you are an investor and some startup presenters introduce you, it's called pitching. They pitch you with their company they want you to invest, and they tell you that in 2 years or in 3 years you will receive the profit of some amount. Then you need to understand what it means, this amount. We already know that money in the future are not equal, their value is not the same as money now. But how to estimate what it means, this amount in current period? This process of moving money back on this timeline is called the discounting. We use the discount factor to multiply on the cash flow in the next periods. This is the formula of discounting. You see, it is reversed formula for the compound interest. Okay, you see, discounting, we will always work with a compounding interest. Because in the investment, we assume that we reuse money all the time. So we receive them and we accumulate and capitalize them and receive again. And when we're going back, we also should use this compound interest formula here. And this is discounting factor. So in order to find how much money values currently, this is called the present value of the money. What is the value of money that we receive next year? What is value of this money now when we make the decision whether to invest or not? In order to answer this question, we multiply this amount on the discount factor, or like we divide, this is the same, or we divide them on the part which is here in denominator. This is the basic part of the discounting. And T here present the number of periods. If we talk about 1 year, then we discount them at 1. And we have 1. If we talk about 2, when we discount them at 2. By default, we go with the interest rate, with the annual interest rate. So interest rate per 1 year. But it can be also specified interest rate per month, interest rate per day, depending on the issue that we work with. And interest rate in 1 day, maybe you might came across advertisement of the microfinancing organizations, and they, in their promotion, they might say that you can borrow money and pay us only 1% per day. But 1% per day, if we consider only working days, so 200 days per year, it is like 7.6 times. So it's 760% per year. So it is annual percent would be 760 if you use the compound interest. The takeaway here, when you're involved in some financial transactions, make sure that you understand each other correctly. And by default, there is always annual term. But if you are offered monthly or daily term, make sure you converted them to the annual term and compare them with other alternatives. Because when you see some unusual time period interest rate, particularly in advertisement, it might be the signal that something is wrong there, and they want you to overpay. But by default, we go with the annual terms. And another important thing that I wanted to emphasize here, that when we talk about the cash flows, no, let's say we have the cash flow in period 1. So period 1, year 1. Year 1, like there are 365 days in this period. But in our calculations, if it is not specified, if something else is not specified, we always mean that it is the last day of this year. Yeah, so 1 year from now, so the phrase, you receive money in a year. In the first year, you receive some amount of money. It means that you receive money in the last day of this year. And that is why we use discounting, because you might think that in the year 1, it means now, but if you receive money now, we don't need to do discounting. I emphasize it because I saw your colleagues make a mistake there. And please keep this in mind that by default, if we mean some period in these circumstances, we mean the end of this period. So there are multiple applications of this present value formula. Some slides ago, we had a case with a 7% per year investment for 2 years, and operation of discounting is the opposite to the operation of compounding. So compounding is going from the current amount to the future amount, and discounting is going from the future amount to the current amount. I would have a slide to illustrate it here. This is the present value of compounding. So some slides ago, we had how much money we would have if we invest 100 years for, let's say, 20 years. And here we have the opposite question to answer. What would be the value of $100 that we receive in this number of periods, in this case in 20 years? What would be its value now? And depending on the interest rate we use, the value would be different. And this is the same thing to work with. Also, this interest rate and interest rate over time, it is very relevant for the credits. When you borrow money yourself, you might need to you should be able to calculate how much money you pay per year and so on, and different ways of estimating it might affect the financial results. Yeah, this is the slide I mentioned before. So this is where we put together the compounding and discounting. So going in the future from now, it's called the compounding, when we use compound interest to estimate how much money we earn on the deposit. And going backwards in time from the nominal amount that we receive in some period in the future, what would be its value now? It's called the discounting. Another example that we should discuss here, valuing an office building. We have some investment option. The cost of construction would be 700,000. After 1 year, we expect to sell it at 800,000 price. Let's estimate the result of this investment. And here we come across very important issue. And this is the most difficult part in discounting, because the technicality of discounting is very straightforward. It is only formulas. They are very easily computed in the Excel spreadsheet, or if you need to be more sophisticated, you can use some specialized tools. But technicality is very simple. With Vladislav on the seminars, you will practice it. And no, I believe you learn it and you won't have any troubles there. The main problem there, maybe you can guess what is the main problem here in discounting. Where the problem is, what is uncertain here? What is not clear? Value of what is not clear in this whole thing? No, we have cash flows, we have number of periods, we have discount rates, and out of them, no, cash flows themselves, depending on the project, might be also uncertain, but no, for future value, no, future value, it is already the result. What future value would be depends on the input that we have, and input includes the cash flows and interest rate, the discount rate, or hurdle rate. There are multiple synonyms. And equality of the risk. Yes, Bogdan, you heading us to the right direction. The difficult part here, and we will spend separate classes, even multiple classes, on discussing it. The difficult part is to find the right discount rate, find the right rate that we use here. Here it is 7%. In most exercises, when we practice, we will offer this rate for you, or we will offer components to estimate this rate yourself. But in practice, this is a tricky thing to do. But anyway, there is a line of thought that you should use in order to be, if not precise, but at least reasonable in your estimation. And the thought process we use here is the following. We try to find the projects with a similar level of risk and compare the cash flows that we receive on our project with the interest rate of the projects of the similar level of risk. Bogdan, you are correct in the sense that what would be the similar rate of risk is also not the straightforward question. If we talk about securities, we can more or less safely say what would be the same level of risk. So there are, like some of you guys are also Bogdan mentioned the terms, the blue chips. The blue chips are the biggest firm, the securities of the biggest firm on the market, and we assume that they are more or less equal in terms of their risk, and we can use the performance of another firm to compare it with the performance of our firm. So we use these returns on the similar level projects in order to estimate the return on our project. And this is how discounting works. And this is the point of explanation I just made was to support this part, equally risky investment in the capital market of a return of 7%. This is how it works. We are looking for some investment which is with a similar level of risk and use it to compare with the performance of our project. And sometimes we do it in multiple steps. we discuss it in subsequent classes, but the idea is that the risk and return, they are tied together. And in order to estimate the return, we should consider the risk. And they both would be estimated in this interest rate. And we use it to find the present value of the project. Going back to our example, we can estimate the present value of the amount that we receive when we sell this building next year for 800,000, and the present value would be 747,000. And no, this is called the present value. And now, using this example, we are introduced to the idea of NPV, net present value, and the only difference between present value and net present value would be that in the net present value we subtract initial investment that we make. Sometimes people use as a PV. No, instead of NPV, people sometimes write PV, but strictly speaking, NPV should consider all the investment we make, so it is a final result of the project. And the basic rule there would be, if NPV is positive, it means it is a good project and it is a project which is appropriate to accept. As for the discounting, we use the return on the projects with the same level of risk. And if after this discounting, the value we receive is a positive, it means that the project is better than alternative project with the same level of risk. And that is, as a consequence, we decide that we can accept this project. This is quite straightforward. This is formula for NPV presented in a general form. This is NPV for the single period. There can be multiple periods as well. So we might, for example, I think we will have this example. Just NPV, so discounted value of the incoming cash flow minus required investment. No, here it is the same thing here, as C0 initial cash flows would be the investment, and cash flows, no, they can be negative. They do not have to be positive. If we invest, it means that we spend money, so it is negative cash flow, and C0 is zero. No, excuse me, C0 initial cash flow is negative, and it is investment. So there is no conflict here. It means the same thing, and this part is the present value of the cash flow in the next period. And depending on our assumption about the risk of the project, the present value would be different. If we thought again, or maybe situation on the market changed, and we realize that project is more risky than we expected, it means that we have to adjust our present value calculation. And instead of 7% discount rate, we use higher discount rate of 12%. And it will substantially affect the result. The present value of 800 would be already lower. And so this is the idea that we started from. If the project is more risky, the present value of the cash flows of this project goes down because we have higher discount rate. If the project is more risky, we demand higher return on it. And it is, again, demanding higher return, we use higher discount rate. It all resulted in a reduction of the present value. we have here? No, yeah, here we have alternative NPV calculation. So all premises are the same except for the discount rate. As in this case, we consider this project more risky, even though we expect the same cash flows, but the likelihood of receiving these cash flows is probably lower. And that is why NPV goes down. Except in projects that... Again, and here you have a NPV rule, NPV net present value quality, NPV rule of judging the project, of deciding whether we should invest or not. And NPV rule is if NPV is positive, we accept this project. It means that the project is better than alternative project with the same level of risk. And alternative, we can reverse this rule to the rate of return rule. And no, basically it would be the same rule, just going from the NPV. No, we can estimate the profit of the project. And by the way, the formula you see here, profit divided on investment, this is very simple, but again, very fundamental formula. We'll use it in every time we work with the stock market, for instance. The profit here can be estimated as a change in price of the asset. We purchase asset for 700, next year we sell it for 800. Investment would be the price that we paid, then we purchase it. And this is return in its basic form. When we have just two periods, the return is easy to estimate, and this is 14.3. And this is 14.3 by the end. The question for what would be NPV of this same project of 700,000 to invest now. Next year we receive 800,000 back. What would be NPV of this project if we use discount rate of 14.3%? What would be the NPV of this project in this case? What do you think? So let's go back. When we used 7%, NPV was 47. 47 because we subtract 700. When we used 12%, NPV was 14,000. When we go for 10, it's getting to 27,000. But if we take 14.3, yes, David, you are right. But I believe you calculated. No, this is just due to the rounding. The difference would be because actually, if we put more numbers after the comma, the result will be 0. Okay? And this is 14.3 is a threshold. It is a level of return at which the project is getting the NPV is 0, and if the return of the project is higher than 14.3, then we accept it. If it is lower, then we shouldn't do it. We have discussed. And if we have multiple periods, then we should use the same formula. Just the only difference would be that we would have multiple components here with a different. Each time we put in a different power. In the period 1, we start from 1. In the second year, it would be 2, and so on. And the point here, if we if we have more periods, like in this case, we made our example more realistic. We assume that for 1 year we kept this asset, and it brought us 30,000 cash flow. And as a result, we should transform our cash flow estimation, and the performance of the project will get different. And using the different discount rates, we will have different results. And this threshold discount rate, at which NPV equals 0, it is called internal rate of return. Internal rate of return, it is an alternative. So the point would be the same. When NPV equals 0, in other words, we can say that return of the project should be higher than the return of the project should be higher than the discount rate that we use. If we use the discount rate of more than internal rate of return, NPV is getting negative. If we use it less than internal rate of return, then NPV gets positive.
Can I have a question, please?
Yes, sure.
We had the slide with the rate of return rule. With
Rate of
for just a second. Rate of return rule with the example. So in this example, we understood that 14.3% is the minimum percent when we can, no, not the minimum, but we need to invest in this project if the rate is higher than 14.3. So in this example, they said like the rate is 12%. So in this case, we do not invest. Am I right?
Discount rate. So internal rate of return, what it means. If we have, I showed you example how to estimate the return if we have just 2 cash flow. First time we pay, next year we received, then it is simple to estimate. Let's go back. Simple to estimate the return of the project. We estimate it like this, return. But if we have many periods in the project, 3 or more, then it is not that straightforward to estimate it. And NPV, and this internal rate of return would be the discount rate, which makes the NPV of the project equal to 0. And this is IRR is a single estimate of the project return. And then we compare the discount rate. So we compare the return of alternative project with the return of our project. And if the return of alternative projects, let's say 14%, it means that we shouldn't accept our project. If it is less than it, then we should accept it. Have I answered your question or not?
Well, I think yes. So in that example, when we calculated 14.3. So this is like this IRR, right? Or
Yes,
no?
yes, it was the same thing. Just when we, internal rate of return. Yeah, so it is, in Russian we say внутренняя норма доходности. This is the characteristics of project return. Yes, and this is single, and this is the same thing that was here. Just again, for the case of these two periods, it is straightforward to estimate. But let's say here, in this example, we have investment, then 2 periods of some cash flows. And as a result, it is already not, we cannot go with a single formula to estimate return of the project in some single percentage. In order to do it, we need to, we can use, for example, optimization technique in order to find when NPV is getting to the zero. And this single percent, this discount rate, represents the return of the project, and it's called internal rate of return. And this is the single estimate of the project return. And then we compare it. And this is the same thing there, but for the case of 2 years, it is straightforward to estimate. For more periods, it's more difficult to estimate. But again, these days we do everything electronically, and this is easy to do.
Okay, I think I got it. Thank you.
This is the rules how we work with. By the way, I saw the Amirar Salam wrote, "Can we discount rate be a combination of inflation in that country and the risk of the project?" Yeah, you are correct. It's as I told you, this is the separate big topic to discuss, how to estimate the discount rate. And in a sense, you are right that it is combination. Not exactly inflation. It would be combination of the risk-free rate and the estimation of the risk of the project. But it is something we discuss later on, not today. But we definitely do it. There are 2 rules, NPV rules, and they are the same. They mean the same. They cannot conflict with each other, those 2 rules, because it's just pure math here. We accept project with positive NPV, and we accept project that offers a return of return that exceeds the opportunity cost of capital. Opportunity cost of capital is the same as the hurdle rate. So we accept projects which have internal rate of return higher than their discount rate, and we accept projects that have the positive NPV. And this is the same. It always will be the same, just depending on your the way you put your question. And because just due to the technicality of the process. Here we have more formula of return in the general form, and this is it. So the price in the period 1 minus the price in the period 0. Period 0 is usually means now, how much we purchase at the moment, and then we can estimate the return. And if it is just 2 periods, this period 0 and period 1, then internal rate of return would be the same as return. And those 2 formulas are equal. And you will use these formulas, by the way, in our homework assignments. Then we will work with the stocks. We usually download the stock prices, and then we separately estimate the return with this formula. Not that difficult to do. And another important characteristic of the project is a payback period. So far we discussed NPV and an internal rate of return. We see that they never conflict with each other, but payback is a different perspective on the cash flow, which is also important. Here we have a perspective of estimating when the project breaks even. It is number of periods before the cumulative forecasted cash flows equals the initial outlay. The payback rule says that the point here, we estimate in what time the project breaks even, how much when we receive enough money to compensate on all the investment we made in the project. And this is payback period. And payback, no, it's payback period. Therefore, it is estimated in units of time, in years, months, days. Oh, I'm not sure about hours, but if we want, we can even estimate them in hours, but mostly up to days. Breaks even in the sense that we have some initial investment, then the total result of the project goes down, so it's negative, and then we receive some money, and finally it's getting even. So we compensated on the investment we made. If all cash flows are equal, then it is very easy to estimate. It is initially and the nominal payback period is easy to estimate. It's just investment divided on the cash flows that we received. If it is the same period, then we divide on those cash flow on the single one, and the number we get would be the payback period. So if we say we invest, we'll have examples here, but let's say we invest 9 rubles and we have equal cash flows for 3 years of 3 rubles, then the payback would be 3. So we divide 9 on 3, we have payback period of 3. But most of the time, the cash flows, particularly when we mean real projects, the cash flows are not equal. And therefore, the calculation is not that straightforward, but still not that difficult. The idea here would be to estimate. So initially, we need to estimate cumulative cash flow here. After we have the same investment, and in this case, after period 1, we have cumulative cash flow of 150, of minus 150, because it is minus 2000 plus 500 equals minus 1050. Period 2 plus 500 again, it is just 1000. And in period 3, we have cumulative cash flow before it of minus 1000 plus 1900, and we break even in the period 3, because after this period the cumulative cash flow gets to 900, so it's getting positive. And usually we want to have more precise estimation, and then we estimate the fraction of the 3rd year at which we would have this break even. Then we will, in a minute, I will show you the example, but you need to catch the idea. And so far we talk only about nominal cash flow, but the technicality is similar for the discounted cash flows as well. Just instead of nominal cash flow, we'll use the discounted one. But again, we will have the same procedure. This is how it works. We have cumulative cash flows. Here they are. And between year 2 and year 3, we break even. So as it happens between year 2 and year 3, we have here 2, because the payback period is at least 2 years. Then we need to estimate the fraction of the third year, then we break even. And this is how we do it. We have 1,000 to be till the break-even period, but during the third year in total, we earn 1,900. And in order to estimate the fraction of a year, then we break even. We just divide one on another, and this is the payback period. Does it make sense to you or not? This is kind of thing again that some people who hasn't focused might not understand, even though it is simple. Makes sense. Just no, I will upload this slide, replicate it, and no, there is nothing difficult here. Just make sure that you know how it works. If we took at the second project, then it breaks even in a year 1, because the cash flow getting non-negative in the period 1. In the period 3, it's getting sooner. And the payback rule is the shorter the payback, the better. But the problem of the payback estimation is that it ignores everything that happened afterwards. Once the project break even, we are not interested in the subsequent cash flows. But in reality, for sure, we are interested. And that is why this estimation might not be sufficient. The discounted cash flows are presented here. It is the same cash flows, but discounted at 10%. You see that the project B became infinite in the payback period, because instead of 2,000, we have its discounted value, and as a result, we never compensate our initial investment here. And according to this estimation, the best project would be project C. What happens between the step 1 and step 2, when we went from the nominal payback period to the discounted payback period, according to this estimation, the best project is project B. According to this estimation, the best project is project C. And project B already became the worst project, because once we consider discounting, this project doesn't break even anymore. But when we consider NPV, the situation, we have another perspective to judge upon. And if we want to see the performance of the project during its total lifetime, NPV is a better option, because NPV doesn't ignore big cash flow that we have in the period 3. In general terms, NPV doesn't ignore subsequent cash flows, and payback ignores the cash flows that we have after the break-even point. But still, knowing how much time we need in order to break even is important information, and most of the investment projects, they offer this information to consider. And when you judge on the projects, it's better to use both of those estimation and consider them before you make a decision. That is it. We have good timing today. anything to tell me or to write?
Can I just ask a small question about the last part?
About what?
About the last part, the discounted payback period. So which? Yeah, my question is, which project was better in the discounted payback period? I got it in PP, but not in DPP.
Let's take a look again in discounted payback period. Here.
Yes.
No, again, the shorter the better. The shorter time. The sooner the project breaks even, the better. According to discounted payback period, the best project would be project C, because it breaks even sooner. It breaks even in 1 year 95, and project A breaks even in 2 years 79.
But at the same time, B is shorter, isn't it?
Shorter, but the problem is that it's never breaks even according to the discounted payback period. When we consider time value of the money, we realize the inflows that we receive are smaller than the cash flow, than the investment we make, even though their nominal values are equal. But we spend a lot of time today explaining why we shouldn't compare the nominal values. And if we consider the discounting, we see that the discounted payback period is infinite here.
Got it. Thank you.
And in NPV, the bigger the better. Yes, Arina, in NPV, the bigger it is, the better. But no, in the basic rule is it just should be positive. If it is positive, we can accept the project, and among those that are positive, the bigger the better. It means the project is more superior to alternative project with the same level of risk.
Excuse me.
Yes.
Explain one more time shortly about why is it infinite? Speaking about discount payback period.
Yes, sure. It is explained here. So the logic of the payback period calculation is that we estimate cumulative cash flows, and once it gets positive, it is the period when the project breaks even. It is equal to our payback period. And if we use nominal terms, the project B breaks even in the first period. But here you see what happens with cumulative cash flow doesn't get positive here. It is minus 2000 plus 1118, which is, no, it's still negative number if we add them with each other. And further, we have no other cash flows. And as a result, cumulative cash flow doesn't get positive. That as a result, payback period is infinite.
Okay, I got it. Thank you. And another one is we accept the project if interest rate of return is bigger than the discount rate.
If interest rate of, if internal rate of return, it's called.
Internal rate
is higher than discount rate. Yes, you're right. It means that our project is more profitable than the hurdle rate or this opportunity cost of capital, which is the same thing here, which is it means that our project is more profitable than other projects against which we compare our project.
Okay, thank you.
Thank you for your interest. Something else?
And will you upload this presentation on Smart LMS soon, right?
Yes, I will upload all of them.
Okay.
Maybe I'm not in my office today. I'm not sure if I will be able to do it today. I try. No, tomorrow at the latest. Anything else? Good. Thank you for being here today. Stay healthy. Take care.
Thank
Goodbye.
you, teacher. Goodbye.
Thank you. Goodbye.
Bye.
Bye.